Welcome to the Deep Dive. We're your shortcut to understanding what really happened inside the quarter. Today, we're digging into RPM International, specifically their Q1 fiscal year 2026 earnings call.
Yeah, RPM, the big specialty chemicals and coatings player. And our job today really is to cut through the noise. We're pulling out the key insights from management, the numbers, the guidance.
And trying to answer that big question, right? How can a company report record results and still leave investors feeling, well, a bit cautious, almost nervous?
Exactly. That's the puzzle we need to solve. Why the muted reaction?
Okay, let's jump right in with those headline numbers because, on the surface, they look great.
Yep.
Management really delivered on that growth promise. Record revenue, $2.11 billion.
Yeah, beat consensus estimates, and that's 7.4% growth year over year.
Yeah.
Solid.
And the earnings followed.
They did. Record adjusted EBIT, that's earnings before interest and taxes, $337.8 million, which is up 2.9% from last year. And the adjusted EPS, earnings per share, $1.88. Just snuck past what the street expected.
Management must have been pretty pleased with that consistency.
Oh, yeah, they definitely highlighted it. Said it was, the 14th time in the last 15 quarters they hit a record adjusted EBIT.
Okay, so that sounds like a win. Their pivot to growth strategy seems to be working, at least on the top line. So why the caution? Why wasn't the market more excited? If sales and earnings hit records, what's the problem?
See, it's not about the level of growth. It's about the profitability of that growth. The leverage, the market reaction cooled off because of margin compression. That's the key.
Margin compression. Okay, so the adjusted EBIT margin was 16.0%.
Right, and that's down 70 basis points year over year.
70 basis points. So for listeners, that's 0.7%. They kept less profit from each dollar of sales compared to last year.
Precisely. And I think investors were looking at that strong 7.4% sales jump and expecting margins to maybe expand or at least hold steady.
Not shrink by almost 1%.
Okay.
So where did that margin pressure actually come from?
Management basically broke it down into two buckets. First, you had some, let's call them temporary or unplanned costs hitting them. And second, there were very deliberate investments they chose to make. Costs meant to fuel future growth.
Got it. Let's tackle those temporary ones first. If sales are booming, why the efficiency drag?
Well, the biggest piece was internal disruption. They pointed to about $10 million in unfavorable conversion costs compared to last year. This ties directly to consolidating facilities. They've got 6 projects going on right now.
Like closing that big Toronto plant?
Exactly. Closing Toronto, shifting that production to 3 other sites. That kind of thing causes temporary inefficiencies. It hurts the numbers now, but should resolve later.
Okay, makes sense. What was the other unplanned cost? You mentioned healthcare.
Yeah, this one was interesting. Healthcare costs jumped by $8 million versus the prior year. And here's the kicker. They specifically called out $6 million of that increase just over the last 6 months was due to covering weight loss drugs.
Wait, $6 million just for weight loss drugs? They actually quantified that specifically. That feels unusual.
It really does. And I think it's a signal. They're trying to tell the market, hey, this isn't just normal inflation. This is a new significant cost category hitting us.
Kind of a warning shot for other companies too, maybe?
I think so. It's like a data point suggesting this could be a much bigger issue for corporate healthcare costs across the board, a real spike.
Wow. Okay, critical context.
Yeah.
But beyond those temporary issues, there was deliberate spending, right? SG&A increases.
Correct. Selling, general, and administrative expenses. And they leaned into it even as others might be cutting back.
But isn't investing for growth sometimes just an excuse for weaker margins? How do we know this was smart spending?
You have to look at where the money went specifically. And they did break it down. $5.3 million more for hiring new salespeople and support staff. Targeted hires in places like Stonehard and Tremco, they're higher growth areas.
Okay, that sounds strategic. What else?
Another $3.2 million on increased advertising, especially hitting the consumer segment, focusing on digital, social media, e-commerce.
Trying to boost that softer consumer side. And the last bit.
$2.1 million higher expenses related to M&A, mergers and acquisitions, which suggests they're actively looking for more deals, building that pipeline.
So the picture is strong sales, yes, but profitability took a hit from plant closures, that healthcare spike, and this conscious decision to spend more on sales, marketing, and deal hunting.
That's the story of the quarter, basically.
Okay, let's look at the segments. Where did the growth actually come from? Did all parts of the business fire?
Pretty much. All 4 segments grew sales by 6% or better. So broad-based growth, validating the strategy. The real star was the Performance Coatings Group, PCG.
PCG usually is strong. What drove it this time?
Huge quarter for them. Sales up 9.9%, and unit volume, the actual amount of stuff they sold, up 8%. And it wasn't just riding a wave, it was specific wins. Turnkey flooring, protective coatings. They mentioned landing big projects with demanding clients like John Deere for the first time.
That's high-spec industrial stuff. Sticky business.
Exactly. Builds that competitive moat.
How about construction products, CPG? The construction market's been a bit choppy, hasn't it?
It has, but CPG did well. Sales up 6.5%, volume up 4%. Their strategy here seems to be working. They talked about focusing on the whole building envelope, turnkey roofing, things where they control more of the project.
Right, they mentioned that shift. Less reliance on distributors now.
Yeah, management pointed out 10 years ago, CPG was maybe 40% project-based. Today, it's 60%. That gives them more pricing power, more control, and makes them less vulnerable to swings in just, standard distribution channels.
Okay, now the interesting one. Consumer and specialty. Combined, the sales looked okay, but peel back the layers.
Right. Combined sales up 6.6%, but that was all from acquisitions.
Ready Seal and the pink stuff, the big recent buys.
Exactly. Without those, the legacy consumer business organic growth was actually down 3%.
Down 3%. So that confirms the softness of the traditional DIY retail market they were talking about. Paint, home repair.
Yeah. Management basically said that market is still challenging, but they feel they're doing better than the industry overall.
And this ties directly into the M&A, doesn't it? That $600 million they spent on debt-funded deals recently.
Absolutely. It's a major strategic pivot.
Especially the pink stuff. Why is that particular acquisition so important?
Because it gets them out of just the, let's say, smaller, more cyclical DIY pond. It pushes them squarely into the massive cleaning category. That's a $12 to $15 billion market in the U.S. alone.
And less tied to home building cycles, presumably.
Much less cyclical. Plus, it opens up totally new sales channels for them, grocery stores, dollar stores, places their traditional paints don't go. They're deliberately reshaping that consumer segment.
Towards higher margins and global reach. Makes sense.
And across the board, remember, they're targeting those less cyclical end markets too. Data centers, healthcare, infrastructure projects.
Higher specs, better margins, less economic sensitivity. That's the theme.
That's the long-term game plan, it seems. High-performance specified products.
Okay, let's shift to the outlook. Because this is where that market caution really bit, right? The guidance.
Yeah, the guidance definitely felt conservative. Management acknowledged the macro uncertainty, those ongoing facility consolidation costs. For Q2, the next quarter, they're only expecting sales and adjusted EBIT to grow by mid-single digits. Modest.
And the full year. That's where they really tempered expectations.
They did. Full-year adjusted EBIT growth is now pegged towards the lower end of their previous range. That range was high single digits to low double digits, so they're guiding down expectations slightly.
What about pricing power? Q1 pricing was pretty minimalist, the 1%. Are they going to offset cost inflation?
They said pricing should step up in Q2, maybe around 2%, specifically to offset inflation in things like metal packaging and those tariffs we keep hearing about.
Yes, the tariffs. Did they quantify the impact?
They did. So the total hit, if they did nothing, would be around $90 to $95 million. Huge number. They've managed to mitigate about half of that already through shifting production and some pricing, but that remaining chunk is still a drag on margins.
So putting it all together, what's the roadmap from here? They mentioned MAP 3.0.
Yeah, that's their next internal strategic plan. It's being worked on, but we won't see the public version until spring or summer 2026.
So near term, what should people watch for?
Key things are, does that Q2 price increase stick? Do the cost savings from finishing those plant consolidations finally show up? And how smoothly are Ready Seal and the pink stuff integrating?
And despite spending $600 million on those deals, the balance sheet is still okay.
Looks pretty healthy, yeah. They said debt is about 1.8 times EBITDA after the deals.
1.8x. So for our listeners, that's quite manageable leverage. It means they still have financial firepower, right?
Definitely. Plenty of dry powder left, especially if M&A targets get cheaper as maybe private equity slows down a bit. They can keep buying growth if the price is right.
All right, let's move to our not financial advice segment. Time to read the tea leaves from the call and pitch a slightly wild but maybe plausible trade idea.
And the standard disclaimer applies. Purely entertainment, folks. Educational purposes only. This is absolutely not financial or trading advice. Don't try this at home without talking to a professional.
Okay, so given how clearly management split the world, their new cleaning stuff is booming while the old DIY stuff is lagging, I'm pitching a spread trade. Let's call it the DIY decay versus cleanup trade.
Ooh, okay. A spread trade, exploiting that internal shift. Lay out the mechanics.
Simple conceptually. You short a basket of companies that are heavily reliant on that traditional, sluggish North American DIY paint and repair market. The very segment RPM said was down 3% organically for them.
Okay, betting against the old guard.
Yeah.
And the other side.
You go long RPM stock. But specifically, you're buying into their successful M&A pivot. You're long the growth from Ready Seal, and especially that high growth, potentially higher margin global cleaning exposure they get from the pink stuff.
Interesting. So you're essentially betting that RPM can execute this strategic shift, leveraging their new cleaning power, faster than the market fully prices in the decline of their legacy DIY exposure.
Exactly. It plays RPM's deliberate M&A success against the organic weakness they themselves identified in their older consumer lines. You're trading the realignment.
It definitely captures the core tension from the call, a bold play on their strategic execution. So let's recap the whole quarter then. RPM put up strong top-line numbers, no doubt, growth initiatives, M&A paying off there. But the market focused on really two things: those temporary margin hits from investments and plant moves, and that slightly cautious full-year guidance.
Right. And the big question going forward is, will all this spending, all this M&A, actually lead to better bottom-line leverage down the road, especially as they move towards this MEP 3.0 plan?
That's what investors will be watching.
And one final provocative thought for you, our listener, to consider. The CEO ended the call with some pretty extended comments. You talked about American capitalism, the importance of maintaining employee benefits, specifically calling out their 401k match, even when competitors might be cutting back to meet quarterly numbers.
Yeah, connecting it to retaining talent.
Exactly. So the question is, does that kind of cultural commitment, which clearly has costs like covering $6 million in weight loss drugs, does it ultimately pay off? Does it maybe cost more short-term, but deliver better performance over the long cycle by keeping the best people and the company knowledge intact? Something to think about.
Definitely something to mull over.
Thanks for joining us for this deep dive. Continue your own research.